Welcome to Train Future, where ambition meets expertise. At Train Future, we believe in the transformative power of mentorship and training. In this podcast series, I interview leaders and experts from various fields. Thank you, Sanjay, for joining us today. Sanjay, 90% of startups fail. Now, what, according to you, are the key differentiating factors that could be the mantra for startups being successful?
Okay, so the statistics, I believe, are between 70 to 90%. 90% is more IT startup oriented. So let's actually look at the determinants of success as propounded by Bill Gross of Idea Lab, which was a research done over 40,000 different types of startups. And they found the 5 determinants of success are timing, firstly. Second is team. Third is idea. Fourth is processes. And last but not least, of course, is funding or financing. Now, to your point of would inspiring leadership and motivating the team make a difference? Well, yes, but only to a point. So if your strategy sucks, or if it's the wrong strategy, whatever you do is not going to matter. And which is why startups do pivots all the time.
How important is it for VCs to prioritize how their investments will be used and the progress made using the capital?
Well, as venture capitalists, one really has to take care literally even before you finalize everything vis-a-vis the investment. What do I mean by that? Uh, it's a very good idea to do pre-investment due diligence using a forensic approach, not just a normal FDD or a legal due diligence. And do the ref checks, do the reputation check, everything you could possibly do to understand the founder and the team. Also, the thing to discuss with them is the cadence of the reports that are to be generated and submitted. As far as possible, they should be respectful of this and the need for it and not treat it lightly. The other thing is continuing the forensic sort of approach to it after having obviously coached them and informed them that you're going to do that. What it'll save you from is nasty surprises, which is the one thing that every investor dreads, and God knows how many over the past, I would say since the past 30, 40 years, people have been getting an oops here and oops there and lots of value destroyed for investors. So regularity of review, informal sort of reviews also dropping in on the founding teams is a very good idea. The intent is always to find out if there is a roadblock somewhere, is something, are they embarrassed about it? Can you open your Rolodex, reach out to a network, reach out somewhere else and help overcome whatever they may be having to hand. So it's always a positive intent. You should bring tremendous positive energy towards it, but never hesitate to call the facts out as they are. Hopefully, value systems like letting the best idea win on the table, and of course, maintaining transparency as far as possible. That can go a long way in terms of the reporting routines that investors and their teams need to carry out. The finance, numbers, grasp of key concepts related to the numbers. I can tell you if you're in a presentation where CEOs in particular doesn't have a good grasp of the numbers, it's very scary for the investor because the CEO is going to be carrying the vision and also the being able to inspire the team, hold town hall meetings, show them where we are at now, where we are going. These are the key numbers driving the business, etc., etc., etc. So you need them to be very, very aware of the numbers, and you need them to constantly coach their team in terms of the numbers and metrics that matter. Additionally, I would say really good teams have a grip on three different types of numbers. One is unit economics, which we all know is all about what are the fundamental building blocks of value creation in the company. The other one is all about reference costing. In fact, a lot of people have not heard of reference cost accounting, but there's a wonderful book of how to make big things happen by Professor Bent Flyberg, who has got a database of 50,000 different projects. You'll be horrified to know only 5% of those 50,000 projects have shown actual value creation as per the original vision, and the project came in on time, in on budget, and made profits. So when the risk is that high, why not just find out whatever you're doing for almost every key element, has someone done it before? It's like if you're going to buy a car, you would check to see if someone else has bought a car for a similar price or not, etc. Third different type of accounting is made famous by Eric Ries, and it's called innovation accounting. And that really helps you come up with what should be the numbers you track as your traction sort of goes along the journey of growth in the days ahead. So these are three, in addition to all the other numbers you need to keep track of. Some of the basics. Of course, you set a budget, you do your monthly actuals, and look at the variance seriously and not just pass it off, but actually investigate it. And that's why I was saying having a forensic mindset is a very helpful thing to inculcate from the very beginning as a hygiene.
Over the past 5 years, VCs have shown a strong preference for investing in strong teams over just unique products. Now, studies indicate that VCs value experience, skills, and cohesion of the founding team more than the idea itself. But this makes sense, but there might be situations where a unique idea can come from individuals or teams that are unknown, totally unorganized, with also less experience. What is your view on this?
Question about, teams and the relative ages. Do absolutely green founding teams go and make a dent in the universe? Yeah, that happens sometimes. Do people who are very innovative have lifelong learning curiosity? Absolutely. Can the rate of success be improved by having a mix of teams where you have a lot of youthful energy, creativity, innovation, etc., and enthusiasm, without which you can't inspire and lead people? Yeah, have all of that, but it's mission critical to have a board of advisors that are going to help you de-risk whatever you have identified as the top 5 risks that are going to face the startup through its various chasms and journeys and ups and downs, etc. So, ideal way of actually selecting board of advisors is not just he's my golfing buddy or something else like that, but actually, what are the top 5 risks? Who are the very best in the field who have taken care of this or know how to take care of it, and hopefully onboard them in a nice mix so that each member of the core founding team is supported with somebody with experience as and when required. So it's not an activity where they're going to dominate. But you should know you can pull on that sort of information as you need to.
Apart from these differentiating factors, how is AI being used by VCs for investments and deal flow processes?
Very good question. So VCs receive a lot of decks and requests for funding and all kinds of stuff, which is usually filtered by a junior analyst. Now, since the advent of generative AI, what people have started doing, in fact, we are using ChatGPT 4.0, the Omni version. It's so easy now to ingest a deck into it and then ask it very good targeted questions that normally we would like to ask the founders themselves. So a process which used to take a long time, and if you, let's say you're receiving 20 decks a day, you can crunch through a lot of that in maybe half a day rather than it spilling over to the next day. So Gen AI is definitely helpful. The caution there is, of course, the hallucination aspect of Gen AI.